Good evening, everyone. Welcome to a Be Informed session. My name is Carl Buhariwala and I founded Be Informed to help people make good decisions. Before we begin, I'd just like to let everyone know that this session is being recorded and will be made available to everyone after the session on YouTube. And before we proceed, I'd like to acknowledge the traditional owners on the lands on which we're meeting today and pay my respects to their elders, past and present. Before we get into the session, which will be presented by Ernie of Trident Financial Group, just like to mention that this session is being presented to you today in Australia and considers the applicable regimes in Australian states and territories. So just bear that in mind when you are listening to the seminar, and if you have any specific questions, please direct them to Ernie or through to a professional specializing in the area that you wish to explore. The information is current as of today, so also bear that in mind. If you're thinking about referring to this information in the future, please check whether it's still up to date. So today's session is on property investment, and more specifically around 5 budgeting tips to help you buy an investment property. And I think it's quite important in this market where people are worried or maybe opportunistic in relation to the cost of living pressures, how best they can supplement their income. And whether it be the share market or it be doing another job or investing in property, all activities come with their risk and their opportunity. So today we'll be looking at the property investment market and what you can do in terms of taking steps to budget for the purchase of a property investment and then the ongoing sort of maintenance and progression of that activity throughout the term. So I guess without further delay, let's pass on to Ernie. And if you do have any Q&A, any questions, please do submit them through the chat function, and I will then relay them to Ernie during the Q&A part of this program. So Ernie, when you're ready, I'll pass on to you.
Great. Thank you, Carl, for that kind introduction. And good evening, everyone that are joining us. I thank you for the opportunity to share this with you this evening. And just a little introduction about myself. I'm Ernie from Trident Financial Group. Been working as an accountant for a good part of 20-something years now. And property is really one of the passions in my life, in property investment. I also passionate about teaching people about financial literacy. So on my Fridays, I tend to run financial literacy program. And one of the things that I like to do is just helping people get to a point where they can actually buy property. So that's just a little bit about myself. Really, next slide, please, if you could, Carl. When we talk about investing in property, and any investment really for that matter, is we really need to begin with the end in mind in terms of what are you looking to aim at and what you're wanting to achieve with your investment. A common question that I often get asked by my clients when they get into property investment is whether they get into property to save taxes. So one thing you want to just be mindful is when you're getting into any particular investment is not letting tax be the main driver of your decision, but really looking at the investment and making sure that it's actually sound and actually giving you a return. And if the tax benefits that come with that should only really be a byproduct, but not really the driver of your investment decision. So when you come to a point of deciding to invest in property, then you really need to look at the longer term picture of getting into property investment. So one of the questions that you probably want to ask yourself is, perhaps, you know, what you need to retire on in the future. And for some of you who may be a younger investor, for example, often that's not a question you think about. And certainly not a question that I thought about when I first went into property investment. But I certainly would encourage you to look at it from a longer term perspective, because property is certainly an asset class that is not to be bought and sold in a shorter term, but something that you would look on a longer term horizon. So when you ask yourself the question about what you need to retire on, really you're wanting to establish what you want to end up with in terms of the passive income that you want to live off when you retire, and you kind of work backwards from there, because that really determines, what sort of asset you need, the rental return, for example, that you need to then help you achieve that passive income in the end. And when you have that in mind, that will help you a lot and go a long way in helping you to plan and budget and work out what you actually need to get today to get you to that point by the time you retire. Then we look at things. Some of the things that you probably also want to avoid is when you're looking to get into property is not following trends. So it's not getting into property because your friend is doing it, or your next door neighbor, or maybe you overheard some colleagues talking about it. So it's avoiding the FOMO, the fear of missing out, and letting that be the driver of your investment decision. So it's really making sure that you have a sound reason for why you want to get into property investment. Then we look towards, what type of investment property you should buy, and whether that's going to be a unit, an apartment, or a house. And again, that will then form your basis for your investment plan overall. Next slide, please, Carl. And so once you've established why you want to buy an investment property, then you really want to just be able to put a plan together. And you've probably heard this saying before: if you fail the plan, you plan to fail. And I would say that saying is true in pretty much every aspect of life, and particularly with investments. You definitely want to plan what you're doing. You've probably heard the SMART acronym before, setting financial goals for yourself and making sure they're specific, measurable, attainable, relevant, and time bound. You really want to make sure that when you're making a plan, that you're failing on paper first, so that if the plan, as you're putting and laying it out on paper, doesn't work out, then at least you've failed on paper, you've trialed it out and made sure, okay, this doesn't quite work. Let's try something else. I would typically recommend, if you're looking to get into property investment as part of your budgeting, is to factor in at least 2 to 3% additional interest rate rises when you're setting your budget. That's certainly something that I did when I was modeling my first property purchase, and I was trying to work out whether I could afford the property, is making sure that I had a buffer, so that if, for example, as we're seeing today in this current market, the interest rates are continuing to rise. So certainly what you want to do is avoid a scenario where you're buying a property and then all of a sudden finding yourself in a situation where the interest rates are rising, and you may not be in a position to make the loan repayments if you haven't factored in the interest rate rises in your budget. So that's certainly something that I would recommend when you're planning out whether you can afford an investment property or not. And then in terms of developing a budget, I would say to work with a mortgage broker, because a mortgage broker is going to help you work out what your estimated loan repayments would be, and certainly be able to give you an indication of what the estimated timeline would be to pay off the loan. So certainly an LI when it comes to property investment is certainly having a team of advisors. So that might be having a really good mortgage broker on your team, and then having an accountant and potentially even a financial advisor on your side to work with you to set up a budget. If you're somebody that's like me, where I work with Excel uh, documents all the time, then if you're savvy in that way, then you maybe want to give it a go yourself. There's a lot of budgeting tools that you can probably find on Google that you can download and just populate all the different things. I would say to be as conservative as possible, to really have a chat to a real estate agent first when you're trying to work out, the potential rental return on a property. Real estate agents I have found tend to overinflate the rental income. So you probably want to just be a little bit more conservative and go on a lower end when you're doing your budget in terms of what you potentially might receive in terms of rental income when you buy a property. And then with your expenses, again, being very conservative, I would probably add about 5 to 10% on each of the different elements of your expenses, just to factor in, any potential rises that come in, especially now with inflation. You want to make sure that you're in a position if things were to increase in cost, you're ready and you're in a position that you can cover that because you've been able to take everything into consideration. Um, Now, if you were like me when I first started out, I was probably in positions where I felt stretched at times when I first bought my property, and you may want to maybe get a job on the side, uh, and that could be getting a casual job on an evening, or maybe working a day on a weekend, um, and and it's not to feel that that is not a good strategy. That is very much something that you can consider doing. If your current income is not in a position where you can maybe save enough for a deposit based on your current income, I would certainly encourage looking into that and considering, whether that could be a possibility to help boost your savings and be able to set aside a better deposit for when you get a loan. Um, Something that um, I often see when I'm helping clients out with looking to buy an investment property is looking at their existing debt situation. Often one of the things that banks look at is whether your existing credit card uh, is, the level of your existing credit card debt and your history in terms of repaying that. So you certainly want to demonstrate um, your ability to be able to clear out your existing debt and keeping that to a minimum, because that will definitely impact the amount that you can loan from a bank. Um, and certainly, if you're looking to clear out your credit card debt, you may have come across a term called a snowball strategy. So that's really just looking at all your different debts. If you have more than one credit card, for example, you really want to clear out the one that has the highest interest rate first, and then work on chipping that away, and then moving on to the next one. So that's the snowball strategy. Next slide, please, Carl. So once you've established a plan, you want to also have an understanding of the cost to purchase and hold an investment property. There are really three key things that I would certainly consider when it comes to considering the cost of purchasing a property and holding it over the long term as well. Is the initial stamp duty uh, of purchasing a property in Australia, which, given our level of property prices, particularly in Melbourne and Sydney, and given some of the other capital cities around Australia, property prices in Australia are quite high, and typically stamp duty is a large component of your purchasing costs. So you want to make sure that in your planning and in your budgeting, you're factoring these costs into your plan. Um, uh, Again, if you think of it from a strategic point of view, you may want to consider looking at different states. So not limiting your options to only the state that you're living in. Obviously, it makes things easier if it is in your state, especially if you're looking to be able to inspect your property. But something that I always encourage and I would say is don't limit your investment options to just being in Victoria. A state that you may want to consider is South Australia when it comes to investing in property. And the reason for that is there's been huge changes to the immigration laws and the ability to come in as a permanent resident visa holder in the state of South Australia. So basically, what that means is there's a greater influx of immigration coming into South Australia. And normally, what you'll find is there's a lag in the property market uh, in in relation to immigration numbers. So what I would anticipate would happen in South Australia is that over the course of time, we should see quite a steady rise in the property prices there. Currently, their market, property prices in South Australia, for example, is a lot lower than Victoria. So you could consider, if your budget doesn't permit for you to acquire something in Victoria, is potentially looking at somewhere like South Australia where you could potentially achieve a higher than normal capital growth in comparison to a state like Victoria where our property prices are probably at its peak at the moment. Some of the other things that you might want to consider is potentially getting a property off the plan. So basically, what an off the plan property is anything that is planned for construction and the construction hasn't commenced. And so basically, what happens is a stamp duty concession is available on the construction component of that property. So that means there is a reduced stamp duty cost attached to that. So potentially that's something that you might want to look at when it comes to investing in property. Another consideration you want to think about as well is looking at whether you acquire new property or fairly new property versus an older one. The reason you want to think through those considerations is because with newer properties, the fixtures and fittings and the building itself is going to be relatively new. And so from a tax perspective, that's going to provide you a better depreciation deduction. So that's certainly a key consideration to think about. Older properties tend to not be able to provide you with that sort of tax benefit. And also as a byproduct of considering new and old properties is that older properties are generally going to be more prone to wear and tear issues, and you're probably going to likely find yourself in a position where you're going to be footing cost for repairs and maintenance if the tenants are constantly calling the property manager to have something fixed. So these are things that you want to keep in mind when you're thinking about a particular property to buy. And then the third consideration really then is, once you've decided on a budget, you know what you can afford, then you look at the different options that you have by way of apartments, units, or a house. And that really will just be a byproduct of the budget that you have available to you in terms of whether you can afford one or two or three of those options. Typically, you will find with apartments, and something that actually a lot of people don't think about when it comes to investing in property is land tax. Land tax is something that's very unique to investment properties, something that you don't see when you have a main residence. So if you currently have a main residence and you're considering buying an investment property, you're probably not used to seeing land tax applying to your property because main residents typically have a concession attached to it, so land tax does not apply. But for investment properties and even main residences that eventually become investment properties, land tax will apply where you rent the property out for more than 6 months in a given calendar year. So that's the year in which the state revenue office typically would assess land tax. Normally, I find just by experience as an accountant, apartments generally don't tend to have land tax, and that's typically because the land component of an apartment is usually quite low, uh, and because land tax is applied on the land value of a property. So if land tax is potentially something you want to avoid, then maybe an apartment is an option for you. Units, again, typically the land component of a unit is quite low, but would still be higher than an apartment. So that's something to consider where, again, the land tax should be at a minimum for a unit. Houses uh, certainly have a large component of land and typically would attract a higher land tax bill, particularly in states like Victoria and New South Wales, where the land values are quite high. You may find in some instances the land tax bill can be anywhere between $2,000 to $10,000. And then finally, to take into consideration body corporate or owners corporation. And the thing that you probably want to take away from this one is trying to avoid new bills, particularly new apartment bills nowadays. What I'm finding and seeing is a trend of really high body corporate fees where a lot of builders now, what they do is they charge a lower purchase price on new builds and apartments. But how they end up getting more money down the track is that they will claw it back through the body corporate fees. So you may find yourself, if you were to buy a new build nowadays compared to an older style apartment, so the cost differential you'll see is typically anywhere between 1,500 to about 2,500 in body corporate fees for an older style apartment or even a unit, um, compared to anywhere between sort of 5 to 7,500 for a new build. So quite a significant cost differential, and these are annual costs. So something to keep in mind. These are ongoing costs that you need to consider. So your rental income needs to really be over and above to really cover these costs. Otherwise, you will have to be dipping into your own personal savings to be able to cover that. Next slide, please, Carl. Um, as with any investment, it's always important to measure the investment return, whether you're buying shares, whether you're buying cryptocurrency, or you're getting an investment property. You really want to be able to measure the investment return. And there's really two different yields that you want to look at when you're trying to work out whether a property is a good buy or not. The first one is the gross rental yield, and the simple calculation is really just taking your total gross rent per annum, and you really can just speak to a property agent to try and get an estimate of what the annual rent would be for a particular place to work that out, and then you divide that by your market value for the property, and that will then give you the percentage of the rental yield. The net rental yield is really a very similar formula. The only difference here is that you're taking into consideration the rental expenses when you're working out the net rental income per annum. Um, Something that's interesting to note, and something all banks do when they calculate net rental yield and work out whether they loan you a certain amount of money, is most major banks will work out net rental yield that excludes the mortgage interest. And you might ask the question, why would a bank exclude the mortgage interest when it's trying to work out the rental yield? And really the reasoning that banks provide for doing that is because when you're trying to work out the rental yield, it is in absence of the funding cost of the property. Because from a bank's perspective, it is not a direct cost of owning property. So direct costs are things like council rates because it's directly attached to the property, land tax, for example, home insurance. The reason they don't count funding cost as a direct cost is because some people may be able to buy a property without the funding cost. So it is not a direct factor of owning property. Um, so, um, so keeping them in mind and working out whether something is affordable or not. So if you have, for example, a net rental yield of about 6%, and your current interest rate is about 4.5%. Also, in that example, what you have is a 1.5% differential where you know that your rental yield is going to cover, at the very least, your mortgage interest. But being mindful though that that's really just the mortgage interest and not the interest and the principal repayment. And so you need to be able to look at the cash flow for whether you can cover the interest and the principal component as well. So your question might be then, how do I know what is a good rental yield? So in metropolitan areas, and again, just talking broadly for Australia-wide, and maybe even Victoria, if you're looking at Victoria, is a rough guide of about 3.5% and above. So if you work out that the rental yield is below that, it doesn't mean that the investment is a bad purchase. It just means that you may want to just compare that against another property, um, and, and 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 do your sums and compare, you know, how that stacks up against another property um, in a similar metropolitan area. In regional areas, so that's where we're talking about out in the country, um, you would tend to expect a higher rental yield. So you're looking at about 5% rental yield and above. Again, similar to metropolitan areas, if when you do your calculation and you find yourself it's kind of landing at about 4.5%, that doesn't really mean that that property is not a good purchase. You need to look at the overall investment. Um, so it's not just the income yield that you get from the property, but you also got to look at the overall capital return as well, because something that's unique to property that is also unique to other investments like shares is that there is two components to measuring your returns. You have the capital component, where the market value of the property is going up in value, and then you've got the rental yield, which is the income that you receive from your tenants. So it's making sure that you're looking at the holistic picture when you're trying to assess your returns. Next slide, please, Carl. And then the last thing you want to sort of ask yourself is, how do you determine what you can afford? And um, and really looking at this from a bank's perspective. So this is really just getting practical. Um, and so whilst on paper you may be able to afford a particular property, the banks really set a healthy boundary in terms of what you would need as a deposit before they loan you money. Typically, you would be wanting to aim for about 20% deposit of the value of the property. And the reason you want to do that is because banks will typically apply a lender's mortgage insurance if you don't have enough of a deposit. So you want to make sure that you have at least 20% in deposit. I would say to be on the safe side, probably try to have about 25% to give yourself a bit of a buffer. But if you're stretching your budget, then I would say at a bare minimum, make sure that you have 20% before you go out and get the property. And you also need to have enough in your budget to afford the stamp duty as well. I mentioned earlier that that was one of the costs and quite a significant one that you need to take into consideration. So you need your 20% deposit, and you need enough money for your stamp duty as well, because that 20% does not cover the stamp duty. Um, and something that's important to note as well is banks do not loan you money for the stamp duty. That needs to be covered from your personal cash. Um, Now, in terms of individuals who are on the call that may have a principal place of residence or main residence, if you have paid off a certain amount of your loan, you may find yourself in a position where you may have some equity. And by equity, I mean simply the market value of your main residence um, in comparison to the loan that's remaining on the property. So for illustration, let's just say your family home is $1 million and you have $500,000 left on the loan. Then in that instance, your equity would be $500,000. So what you can do is leverage that equity against an investment property, for example. And you can then go to the bank and say, well, I have X amount of equity, which can then form towards that 20% deposit. Now, whilst that may help with getting a loan for the investment property, something that you want to keep in mind is when you're doing that, you are putting your main residence at risk when you do that. So I would say that's probably uh, a, 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 uh, a thing that you probably try and avoid where possible. But if you do find yourself in a position where you need to tap into the equity of your family home, I would say really speak to your mortgage broker or an accountant to really just double check to see if that's a sensible approach or not. And then you come to once you've done all of those things, you come to then a position where you're having to choose the right loan for the property itself. And there's a myriad of different choices that you can come across. You've got variable interest rates, you've got fixed interest rate loans, then you've got interest only loans versus principal and interest only loans. And the question really is then, what is the right type of loan for an investment property? Typically, what you will find is a lot of investors, what I see is that they would only get an interest only loan for an investment property. And the reason for that is they're trying to free up their cash flow, not having to make principal repayments. So they're just making sure that they're only limiting themselves to making interest only payments. And really what they're doing is they're banking on the fact that the value of the property, the investment property that they acquire, will grow in such a value that it will exceed the principal amount of the loan. And so what I have seen in some instances is people will buy investment properties on interest-only loans. They get to a certain point where the value of the investment property has grown quite a lot and far exceeds the principal loan of principal component of the loan, and then they sell that investment property to pay off the loan. So that's certainly one strategy that you could impose. From my perspective, though, my personal preference is to get a principal and interest only loan. But failing that, an interest only loan is not a bad option if you want to free up your cash flow. Question about whether it should be variable or fixed interest. Really, again, that comes down to the budgeting. In a market where we have rising interest rates, fixing the interest rate may potentially be a good option. But what I tend to find is in a market where you have rising interest rates, typically the banks would factor a premium on the fixed interest rates. So you may find actually, if you're looking at fixed interest rates now, they tend to be about 1 to 1.5% higher than the existing variable interest rate. So next slide, please, Carl. Well, that concludes my presentation. Hopefully you found that helpful. I'll just extend that to the participants now for any questions that you might have. I'll be happy to address them.
Thank you, Ernie. That was a very insightful seminar. I'm sure those that have attended today will find great value in some of the sentiments that you raised around budgeting to buy property investment. It is or will be your most expensive asset, or your second most expensive asset if it's under your principal place of residence. So you want to make sure you get it right. There are cost consequences. It's not a cheap activity or a short-term activity. Property investments long-term. So thank you. And Ernie's details are on screen. So if you have any questions, feel free to engage with him directly. And as Ernie mentioned, he's just one part of a suite of advisors that you will need when you would wish to embark on that activity. So do consider Ernie and others. So just a reminder that we'll now proceed to Q&A, and if you do have any questions, please send them through the chat to me and I'll relay them through to Ernie. But we'll first start off with a few questions that we've got by email for those who can't attend, and then we'll proceed through to the questions that are raised through the chat function.
Sure.
And just a reminder to everyone that's joined that a one-page handout will be sent through to you, through to your registered email address following the session. That's kindly been prepared by Ernie, which summarizes the 5 budgeting tips shared in his seminar. So let's jump into the Q&A, and I'll start off by going to the questions that we've received. So the first question, Ernie, is around, I think you touched on this during your seminar around capital and the rental yield, right? So the two sort of components that people need to look out for. And I think the question focuses here on the capital component. And I think it's like with all of these questions, I think that I can see that they're going to be hard to answer in terms of providing a specific response. I think they're all based on the circumstances. But this person wishes to ask you, what typically is the length of period of time that you see would be enough to see some form of capital growth, right? Now, that's a very hard question to answer. I know a lot of people want to know whether they're going to be making the money out of this other than just the rental income. But based on your experience, how long do you see people needing to be in this game for before they start seeing some capital, growth?
Yeah, that's a great question, Carl, and certainly one that's worth asking when you're embarking and purchasing an investment property or going into any investment for that matter. But certainly for something like an investment property, you want to look at about a 10-year horizon. And the reason for that is that's a safe and a long amount of time to allow for any dips in the market or even plateaus in the market, as we might be seeing right now, where the interest rates are pretty high. So you're not going to see any crazy spikes in property prices in this point in time. So I would say from experience or what I've seen is a 10-year horizon is probably what you want to hold it off. You want to hold the property for at least 10 years.
Yeah, and I think that sort of makes sense with other markets as well. It's definitely not a short-term game, and you need to recover your stamp duty as well and all the other holding costs that you've incurred, and account for depreciation when you sell, because that gets deducted from your cost base that the when you come to the CGT event. So yeah, definitely a long-term game. The next question focuses on the current market that we are in, and I know you've touched on a few points around where you see it heading in the short term. We see that the person's asked that rents are at its probably not at its peak, but they're high compared to prior years. What would happen if rents started to fall because there was extra there could potentially be a high demand by renters, meaning more competition. If rents were to come down, that would of course impact people's budgets, right? So how do they go about planning for that? It's not going to stay high all the time, right? There's going to be some, ebbs and flows. What are your thoughts on what would happen if they do fall from a budgeting perspective?
Yeah, from a budgeting perspective, something that um, people may not be aware of is that you'll find yourself obviously in that scenario where you may be in a income loss position. So you may be more attuned to the term negative gearing, which is a very unique term in Australia. And really, what negative gearing is, it's a scenario where your expenses exceed your income, and so you in that situation where you are making a loss, that loss can then be offset against your other taxable income, and typically that will be your employment income. So that does provide a bit of a tax benefit in that it reduces your taxable income, and then you can use part of your tax refund to put back into your home loan. To manage your cash flow, though, what you can do if you find yourself in a situation where your rents are going down, interest rates are going up, you can apply for what is called a pay-as-you-go withholding variation. You can do that yourself, or you can go through an accountant to do that for you, and it has to be done on an annual basis. I would typically suggest to get it done and redone around 30 June or after 1 July. And what happens is um, you 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 basically take into account all your rental losses and work out what your revised taxable income will be, and then the ATO then readjusts what they think the pay-as-you-go withholding would be on your pay based on that rental loss, and they then send a letter to your employer, uh, unless you're self-employed. So they'll send it to your employer, and they'll basically instruct them to lower your pay-as-you-go withholding. So rather than waiting until the tax year end to get that big refund to then put back into your loan, you're getting that tax refund really on a month-by-month basis. So that's one way to tackle that issue.
Yeah, that's a good answer. Yeah, and I just think that people need to start factoring in now the potential for the rents, to come down because there could be an increased demand by our renters. The supply of properties could also go up, which means that there's more of it out there, which just increases competition. Landlords then have to start, fighting, I guess, to win the renter that wishes to go for their property. So yeah, I think it's
That's
definitely something that people need to have on their mind. And then this sort of leads to the next question, which is, I think, and you have touched on this as well, but just around the budget. You budget at the beginning, but you need to also continuously budget throughout the term of your holding, right? So do you agree that it's a dynamic activity? It's an ongoing activity, right? That you need to keep revisiting every few months, every half year.
Absolutely. It's certainly not something that you do at once or a point in time. You definitely want to keep revisiting that and keep looking at that.
Yeah, yeah. Okay, we'll jump through to the questions now that have come through in the chat. So the first one's just on this principal place of residence and leveraging equity. When, and I think all participants will appreciate this is all circumstantial. It's all based on the particular facts, but in terms of the person's question here around when. So I think what I can get from this person's question is that this person has a principal place of residence. They want to now embark on the property investment train. How much equity should they have accumulated before they start considering whether they've got enough to help them get a good deal, right, through a mortgage broker when they buy their property investment? Like, what do you see from your experience as being the sweet spot before they should start going on?
Yeah, no, great question. Great question. So really, from a bank's perspective, so it's looking at it from a bank's perspective, because that's really how they look at it when they come to lending, deciding how much they want to lend to you, is you need to build up enough equity where overall you have at least 20% in your own main residence, and then you have 20% also for the investment property as well. So if you add the value of your home and the value of the investment property together, and then you multiply that number, that combined number by 20%, that's really where your equity needs to land. And if it's above that 20% mark, then you're pretty good. That's probably where I would be aiming at.
Mm. And I think a lot of people underestimate that figure, right? They think that a small deposit will be enough, and they can just, pay the lender's margin, what that insurance component, and that should get them over the line. But I think, and correct me if I'm wrong, Ernie, but banks are a bit more cautious, especially given the fact that interest rates have risen quite rapidly, earlier than probably most people expected. Costs are going up substantially due to inflation, supply pressures, the economy, global markets.
Yeah.
And this sort of feeds into the next question that we've received, which is, well, how, and this goes towards applying for a loan, right? But how conservative can people be in the figures they share? Or do banks really know what the pressures are right now and will look through some of the, not falsities, but I guess the conservative approach that people sort of disclose on their application form in terms of their monthly expenses? Do you see that, based on from your experience, that banks are really tightening their belts and wanting to make sure that they are not engaging in risky lending practices?
Yeah, I mean, even from my own personal experience, when I'm refinancing my own investment property, I found that the banks themselves, even though you give them a set of figures, they will actually get their own quantity surveyor to basically assess what the rental income should be, what the expenses should be on a particular place. There's certain things that are obviously they will take at face value, which is things like council rates, where you can point to a council rate notice. Water rates or land tax, for example, you can sort of point to that because there's a statement that's really backing the number. Where they will be conservative will be, for example, the rental income. Particularly when I found, just to use an example, during COVID, they would reduce the rental return by about 20% because of the fact that landlords had to reduce rent significantly. So they took a very conservative approach in that instance.
Yeah, yeah. So yeah, I see the same thing as well. I think it's just from what I read in the news and from dabbling in this space myself, it's I think it's important to not underestimate the level of risk which banks are willing to take on.
Yeah.
And having a mortgage broker is good, and they can help you to sort of negotiate better rates.
Yeah.
But ultimately, it's important to I think just be full and frank with the bank and ensure that you're not setting yourself up to fail in the future, I guess, by understating and then realizing that in the future, if prices do go up and interest rates do keep rising, then you're not able to service the loan. So
that's right.
definitely.
And also to add, if I can, Carl, to the question about to the individual who raised the question about leveraging equity on your main residence. Where you find yourself in a situation where you have a main residence and you're looking to buy an investment property, a way to manage your cash flow in that situation is to obviously not just have an interest-only loan, for example, that can kind of free up your cash of not having to make the principal repayment, is having the extra money that you're not that you would typically put into an offset account, rather than putting it in the offset of the investment property, is put it all into the offset of your main residence. And the reason for that is your interest on your main residence is not tax deductible. So any excess amount that you have, don't sit that excess amount in the offset of an investment property, because it's really only going to reduce your deductible interest. So you might as well put the excess on your non-deductible main residence, and then continue to be able to take advantage of the deductible interest and claiming that on your tax return.
Yeah, that's a great tip. Yeah, good tip. Yeah, so just pass on to the next question, which is around just the yield calculations. And I think you flagged that your first point of contact will ultimately be the real estate manager who will be at the property, showing you around and might oversell a few aspects of the potential yield. What can this person wants to know, what can he or she or they independently do to just check, the numbers thrown around? Who's the best sort of person to advise on that, do you think?
You can actually subscribe to data online. I have looked into that, but it is quite expensive. So you got to get a report. It'll cost you anywhere between $500 to $800 to get that, and it is pretty accurate data, and that's just really based on properties that have actually been rented out that are in similar streets, similar sort of makeup in terms of, you've got 2 bedroom, 2 baths, 2 car spaces. So you're comparing like with like, so you can have a really accurate comparison to know, okay, if I were to buy this property, I can be fairly confident that I can get a similar rental yield based on existing property in the same street or similar streets in a similar suburb.
Yeah.
So that's one way. The other way is, you could just do, because what I find now with websites like realestate.com.au, they have really wonderful historical data information where you click on, say, the rental tab of the website itself, and you can actually scroll through all the historical rents of properties that were listed for rent and then they got leased. And because typically what they do is they state what the rental amount is per week. So you can do the filters where you can go, if you were getting a unit, so you can filter by unit, by suburb, by number of bedrooms and showers and so forth, and then look at a 6 month period. I would say probably 12 is unnecessary. I would say 6 months, looking back 6 months, and then seeing if there's a trend and where that market value is sitting in terms of your rental yield. And that's probably a cheaper way to do it if you're not wanting to pay for a report. That's certainly something that you can try.
Yeah, and to that person's question, just go and see other properties and go to their open for inspections and just see the condition and how long it's been on the market for, and the age, and just do your due diligence, I guess, so you can sort of accurately determine what your future looks like.
That's right. And something I didn't mention during the presentation as well is one thing that's unique about an investment property as it compared to other investment options like shares and crypto is investment properties are the only asset that you can actually improve the value yourself. What I mean by that is if you were to buy an investment property that was maybe partially renovated or unrenovated. I bought a property myself that was unrenovated. I spent about 40,000 renovating it, putting a new kitchen in, putting some new flooring, bathrooms, and so forth. And that significantly boosted the rental yield. I mean, this is a real life scenario. I wish I had the ability to show you my before and after, then you can kind of see what that project looked like. But in essence, I had the rental return on spending about $40,000. The rental return went from $575 to $775 per week. So that's an extra $200 per week increase. So I mean, if you work that out over a year, my repayment period of that $40,000 investment was about 5 years. So with that extra rent that I was going to get, in about 5 years' time, I've repaid the capital that I've spent. And not to mention that I can continue to rent it out at that rate once you've spent the money. So that's just something to think about. I tend to favor buying unrenovated properties, particularly in the past. Maybe nowadays, not so much because of rising construction costs. You may find that you're probably better off getting something that's a little bit newer now, because if you were to add on construction costs now, I'm sure that I wouldn't be paying 40,000 in this
Yeah.
today's market. I'll be looking at something like 60 to 80 grand. So that's really going to blow out your budget. So you want to be looking at maybe something a little bit newer now.
Yeah. And also the timing as well, right? I think builders are hard to, it's hard to get for them to get staff, and they've got so many projects that need to complete. It's not something that will just happen, within a month or so. It's a backlog of jobs. And that actually leads on to our final question, Ernie, which is just around this person's asked about body corporate, OC fees. And I think, probably background to this question I can gather is, it's expensive to buy houses. So, cheaper to get an apartment or a unit, there's a low entry point. And the person has asked, well, and as you have said, they tend to lower developers are now lowering the price, also probably lowering the OC fee in the first year, but then gradually building it up to build up the sinking fund and all that sort of thing. Especially with older properties as well, they've got a lot of repairs that need to be done, and you're just one little person paying, for the entire thing with the group. What steps can someone take? I guess it comes back to due diligence, really, but just ensuring that from a budgeting perspective, they're factoring in those potentially escalated costs down the line. What sort of steps do you see that a person can do to sort of manage that when there's a risk that it could increase or just go through the roof in the future?
I would say absolutely avoid those I'm not a big fan of multi developments where I'm talking more than 50 apartments. The problem is the more people you have living in a place, the more potential for things like the lift breaking down, particularly if it has amenities like a gym or a swimming pool. These are things that are going to be ongoing costs, more things to go wrong. I tend to, if I was going for an apartment, I'd actually go for the older style apartments. So I'm thinking something like the 60s or the 70s, where you have an older style apartment that's been maybe slightly renovated or fully renovated. And the reason for that is you'll find the body corporate is typically quite low because they don't usually have a lift. So you have a block of maybe 8 to 12 apartments. That's a really sweet spot there. So you're looking at an apartment block that's only no more than 2 stories. So flight of stairs is not going to be an issue. Also from a living space perspective as well, and attracting better tenants. I know certainly that the older style apartments tend to have more space. You'll find newer builds nowadays, the floor plans are quite tight. They're a lot smaller. And that's also part of the reason why they're selling for a lot less as well, because you're getting less. So that's something that they're, it's not so obvious when you look at it initially, but these are things that do impact the overall capital return, because what I find is that capital returns on the older style apartments tend to be better, purely because of reduced body corporate fees and just bigger living spaces.
Yeah, that's a fair point. I think definitely the newer designs are more open plan, and through the open plan concept, they looks big, but actually not as big as the older properties, floor plans. So good point. So I think that brings us into our Q&A. There's no further questions. So I'd like to thank Ernie again for taking the time to present today's session on property investment. I've found it very useful and learned a few tips along the way, such as putting the offset account in the principal place of residence. That's a good tip. So his details are on screen, and if you have any questions, please do not hesitate to contact him directly. And I'll just move on to the last slide. So just a sort of a thank you for attending the Be Informed session. Please follow us on social media. We greatly appreciate that. That helps to spread the word. The session is being recorded, and a copy of the recording will be posted directly to YouTube following today's session. So you'll see that in a couple of hours when it's uploaded. As a reminder, Ernie has kindly prepared that one-page handout, so I'll be sending through an email after this session. So look out in your inbox to see that handout, which you can then use for yourself or share with friends and family. It's up to you what you do with it. And yeah, just as a reminder, all the information today is general only, and so nothing is specific or tailored to anyone's circumstances. If you do require any specific information, from a financial, accounting, tax, legal perspective, please go and see the relevant advisor so that you are on track to make a good decision. And our next session is coming up on the 7th of June, I think it is. And that will be on the construction industry and sort of business practices, essentially around recent events in the media that might have caught a few property owners by surprise when they're getting their new house built, and what to do from a legal perspective and what they should expect as well. So more of that to come soon, but that'll be on the 7th of June.
Yeah.
So that brings us to the end of the session. Again, thank you, Ernie, for your time. I hope everyone on the call found it useful, and for those listening in the future, thank you for watching.
Thank you, Carl. And bye, everyone. Have a good evening.
Thanks. All right. See you guys. Bye.
Bye-bye.